In this short video, we are going to be talking about SPACs. So what are SPACs? They certainly have been in the news a lot lately, and you may have heard of a number of companies that are SPAC targets and a number of companies that have gone public as a result of SPAC acquisitions. So what are they? SPAC stands for Special Purpose Acquisition Company. It's a shell company that is set up to acquire another company and in the process make that target company public. It's funded by capital from the founders and external investors. They can also use a certain amount of debt. The SPAC then obtains a listing on a major exchange, such as the London Stock Exchange. After this, they typically have a time limit of 2 years to find a target company to buy. If the target shareholders agree to be acquired, then all the cash that the SPAC has been sitting on is paid up to the target company's shareholders, and the SPAC becomes the sole owner of the target. Because the SPAC is set up as a shell, after the acquisition, it effectively becomes the target company itself in terms of its operations. Remember, the SPAC is listed, so the target company indirectly becomes listed by being absorbed into the SPAC. One of the questions that comes to mind when you hear about this process is, why do these target companies not do their own IPOs? SPACs are set up by experienced financiers. These people will have experience of capital markets, having worked in fields such as M&A, investment banking, private equity, and so on. The listing process for most major exchanges is incredibly complicated and lengthy, but remember, the SPAC has already gone through these processes and it's already listed. If the target company decides to do its own IPO, then there's no guarantee of the price they will receive at the end of the IPO, or indeed whether the IPO process will proceed as planned. So going public as a result of being acquired by a SPAC is a shortcut for all of these processes for the target company. It speeds things up and reduces uncertainties. The next question that comes to people's minds is, should I invest in a SPAC IPO? Investing in a SPAC IPO does introduce an investor to a fair amount of uncertainty. This is because we don't know what the target company may be. We don't even have a short list of potential targets because that kind of information is highly confidential. In most cases, you are buying shares in a SPAC based entirely on the reputations of the founders. Another important question is, how do you value a SPAC? Any kind of fundamental discounted cash flows based analysis is simply not going to be possible. That being said, investing in a SPAC can be considered relatively low risk. If within the 2-year time span a target company could not be found or the acquisition could not be completed, then all cash will simply be returned back to the investors minus expenses. What is the future like for SPACs? The Americans are increasing their regulatory scrutiny. There have been some recent examples where SPACs have been unsuccessful in completing the target company acquisition. And this ended up putting the target companies in financial distress because they were counting on the capital injection from the SPAC to continue their operations. Most major exchanges already accept SPAC listings, and there are more exchanges coming on board in the near future. However, as time goes by, we can expect regulations to be tightened up in Europe as well as other jurisdictions. Thank you for watching this explainer video by Fintelligence. If you enjoyed this, please follow our company page on LinkedIn and check out our other videos.